On the Tape is presented by CME Group, where risk meets opportunity, and iConnections, reimagining how the investment industry connects. A warm welcome to the On the Tape podcast. Guy Adami, Danny Moses. Danny, how are you?
I'm doing great, Guy. How are you?
I'm really well. You should be doing great. There's so many cool things going on, and we're going to delve into many of them. But I need to tease something, Danny, because Nathan and I sat down with Kristen Kelly and Jennifer Sarbach. You might know them better as the Wall Street Skinny. Really interesting conversation. They got it going on. We had a lot of fun. I think you'll enjoy it. So stick around for that on the back half of the conversation that the two of us are about to have. Now, before we start, Danny, I'm going to ask you a question. If you don't know the answer, just say, Guy, I don't know, because there's a very good chance you won't.
Okay.
If I said to you the name Kenny Young and Arthur Resnick, does that mean anything to you?
Young and Resnick could be an accounting firm?
No,
Okay.
No, it is not an accounting firm,
Okay.
no. Those were the two gentlemen that wrote a song that was made famous by the Drifters, also made famous by John Cougar Mellencamp. Does that help you at all?
Pink Houses?
No.
Okay. I just thought since we're both wearing pink, we're both wearing pink. All right, keep going.
We are both wearing pink.
Thought that's where maybe you got your inspiration.
Not only the Drifters, not only John Cougar Mellencamp, a litany of people have done it. As a matter of fact, I think the Rolling Stones may have done a cover of it. But the name of the song, Danny Moses, is Under the Boardwalk. And you're saying, okay, Guy, what's your problem? Well, it's Memorial Day weekend, number one. So a lot of people will be going to the boardwalk, and God only knows what happens under the boardwalk. But it got me thinking about summer and those things. More importantly, though, about the market, because although on the surface everything looks great, and we're going to talk about Nvidia, and Nvidia's the market, and blah, 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 under the surface, under the boardwalk, there's some shit out there that's actually sort of scary, Danny Moses. And you know what? I'll start it with this. If you look at some of the reversals we're seeing today on Thursday, by the way, I just want to emphasize we're recording this on Thursday afternoon. The S&P 500 made a new all-time high today, Danny Moses, of 5341.88. As we're sitting here today, right now, it's now 5271. That is basically a 70 handle reversal, and we've seen some reversals in other things as well. The VIX, which had been trading below 12 for quite some time, last 3 or 4 trading sessions, has ratcheted up to close to 13. We're obviously seeing even a NASDAQ that's lower, despite the fact that Nvidia is higher. So my question to you is finally the under the boardwalk, the under the surface stuff that we have been talking about seemingly forever starting to take hold?
I noticed how you didn't reference Bette Midler's Under the Boardwalk.
Well, Bette Midler did it as well.
Okay,
but I
that's
will
all.
tell
I
you,
just want to know.
I sort of like Bette Midler. No, I mean, it's fine.
I didn't even know Cougar did Under the Boardwalk, but that's fine.
Stop.
Yeah.
Stop.
Didn't know that.
Stop.
Didn't know that.
Yes, he did.
Okay.
I don't know if he did it as John
not on his
Cougar.
greatest
I don't know
hits.
if he did it as John Mellencamp. I don't know if he did it as John Cougar Mellencamp, but one of the three of them did.
All right, fair
Back
enough.
to you.
So I think what we're seeing is the secular versus cyclical trade play out.
Yes.
What's been secular? Obviously, AI is massively secular. What else is secular? All the diet drugs and all the stuff. That's a secular trade. All the weight loss drugs have been going on. What's cyclical? Housing is cyclical. Energy is deemed to be cyclical, right? With the exception of how energy may be through M&A and stuff. There's some secular movements going on with balance sheet transformations. But for the most part, it's cyclical. So to your point, Guy, under the boardwalk, the cycles that are happening are in motion. And they're happening, and they're normal cycles that are starting to occur. When you see an ISM numbers that come out, which people should cheer, that are people rooting against because there's actually growth coming back.
Right.
The problem is that you have sticky inflation within those ISM numbers. So the fear is, for the people out there that think, oh, the Fed doesn't matter and rate cuts and all this stuff, it does matter. Because in order to get, quote, I believe, a cyclical soft landing to occur, you're going to want the Fed to be there for you, and they probably will be there. But here's the thing. Let's take Toll, for instance, which I think is very indicative. Great company.
And when you're talking about Toll, just so people know,
Toll Housing.
Toll Brothers.
Toll Brothers Housing, who reported earnings.
Right, the builders, right? And just before we even get into it, I mean, we're talking about a group of stocks that recently, and when I say recently, I think Toll Brothers made its all-time high on May, I don't want to say 15th. So
we're
a week
right
or
around
so
here.
ago,
Exactly.
it was about 135 or so. It's sold off since, but your point is well taken. Please continue.
Well, my point on this is that we had Ivy Zellman on. We're going to get her on again here soon. Talk, maybe a quarterly update here, housing can't be memed. Housing can't be secular. It can be it was secular for a period of time when people were, quote, moving out of the city. But when you talk about a sector that moves to cyclicality, Toll Brothers is in the high end, right? Their average home price is, I don't know, I think what, 900,000, $1 million, whatever it might be.
I think it's over $1 million now. Yeah.
It's like around that level. They had a great quarter. That's fine. But housing stocks traditionally trade between, obviously, 0.5 times book value in horrible times and maybe 2 times book value, where this thing actually literally hit to the Carterworth, to the penny, and kind of sold off. My point is that that it's a great company. It's fine. The reason it trades at 7 times earnings is because people don't think it can go on. You actually are having home supply now come on, and guess where? At the higher end finally coming in. So again, not catastrophic. There's nothing wrong with Toll. It's fine. My point is that there's certain sectors you can't take up anymore. So under the surface and under the boardwalk, what you are starting to see, I believe, is a real cycle starting to occur, the lower end consumer. Let's talk about another company. Let's talk about Target versus Walmart, which I think is really crucial.
Okay, yes, I want you to go on, but I want to tell the folks listening, if there are any new listeners or viewers out there, that Danny Moses has been talking about, waxing poetic about the merits of Walmart for the better part of the last couple of years, correctly. I mean, we're talking about a stock that seemingly makes a new all-time high each and every day. You're also talking about a company that just recently reported, a company that seemingly has got their act together in the form of inventories, which I think were sequentially down 2.7% year over year against pretty decent sales growth. So they have figured it out, and they're doing a good job, and people are clearly trading down to them. Please continue.
No, the point is that they're in a position because they were growing their e-commerce business, Walmart. Well, that was actually a secular shift for them, right? And at the same time, because they have the lowest prices of things, groceries, things that you need, that are not discretionary, right? Things that you actually have to actually go buy, they've been benefiting from it. So we can see from the Target quarter, again, I'm not short Target. I wasn't saying to short Target. I'm not saying that at all. What I'm saying is you can see what's happening in real time right now within this economy. And it's actually, everything kind of makes sense. Forget about where the S&P is for a second, because the stock market is not the economy. All I'm saying is the cycles that are starting to occur, the lower end consumer is not doing great, right? It's going through a, quote, normal cycle. It appears the lower end consumer is going through a normal cycle here. That's fine. You can still find stuff to own here. My point is that I think the haves and the have-nots continue to separate themselves. And I think this AI craze, and by the way, it's justified. I'm looking at Nvidia's numbers. You should not stand in front of that freight train and try to short the stock. Whether you want to be long or not is a whole different story, Guy. But it certainly justifies where it is on a relative basis from, we began this exactly a year ago, Guy. When they reported this quarter a year ago, this frenzy kind of began. But I want to make a point on kind of this thing, and I want to go back again. This is very crucial for people out there so they can understand kind of the professional money management space. The way that passive flows dominate this market and have been for the last 10, 15 years, and it doesn't look like it's going to abate at any moment. If you're a large cap portfolio manager and Nvidia needs to be maybe market weight, you may try to underweight it or overweight it, it is too big to ignore. So I think you had fund managers out there, again, Guy, that are like, okay, I'm not buying into this thing. Finally, there's no way it goes up from here no matter what they kind of report here. And guess what? Stock goes up. This stock could easily be down $100 today instead of up $100, Guy, with the same justification of, it didn't blow numbers out as much as it did last quarter. My point is that hands get forced. So you have a technicality in the market here, I think, that is forcing passive flows. But don't misread, Guy. I'll end with this. Don't misread this. What's really happening under the surface here, and we're here to talk about some of these other names where there's stock picking actually going on, is the secular versus the cyclical trade that's kind of out there, Guy, because I think it's important to discern that.
Are you familiar with Gary Rossington and Alan Collins? It's a yes or no?
Maybe.
No.
Okay.
The answer
no,
is
I'm familiar.
Okay.
But I can't...
it's funny. What's funny is
I'm familiar, but I don't know it.
Question, okay. And then I say yes or no, and I say it's binary. And
no, you said, do you know? You said, are you familiar with? Anyway, go ahead. Right. I know those names. Go ahead.
Okay, so Gary Rossington and Alan Collins were the lead guitarist of the great Leonard
Skinner. Oh, it wasn't
Skinner.
R.C. Cola. Right. Okay. Go ahead.
Okay. And it was not R.C. Cola.
Right.
No.
Keep
I
going.
mean, your mind is in a completely different place.
All right. Go ahead.
Obviously, we know what happened to the members of the band Leonard Skinner.
Yes, I do.
A tragic plane crash in Gillsburg, Mississippi. October 20th, 1978, if memory serves, okay? I mention that because then Gary Rossington and Alan Collins started a band called the Rossin and Collins Band, and one of their songs was Don't Misunderstand Me. And I want to be clear, don't misunderstand me either. Danny just said it, and I will say it. I think Nvidia is an extraordinarily important company, clearly. My concern, though, is, Danny, and you can opine on this, that magically I think people believe that the cyclicality, which has historically been in semiconductors, has magically gone away. Like it's no longer going to be a cyclical, it's just going to be these secular growth stories in perpetuity. Personally, I don't think that's going to be. Now, with that said, I mean, it's hard to say anything negative about that quarter. The slowdown in China notwithstanding, but your point is spot on. People are forced into certain things because they have to be. And to a certain extent, I think that might be what's going on today, at least with Nvidia.
But look at these things. So South Korea comes out today. And again, on a percentage basis, when you think about, some of these companies that are multi-trillion-dollar companies that are out there in tech land, it may not seem big, but they're now pouring in another $19 billion into basically incentives to make chip makers stay there and build from there. That's on top of the $81 billion that was already announced. That's on top. So you do have this tailwind behind you with government money subsidizing some of this. So you have to appreciate that and pay attention to that there are a lot of people banking on this AI. I mean, when AI reaches utilities and utility stocks start to trade at multiples they've never seen before, whether that's justified or not in a regulated market, we can talk about that some other time, it has become so important. Now, at some point, it will become cyclical, but for now it's secular. So I guess what I'm saying is, was I long NVIDIA? Absolutely not. Like, wouldn't be, that's not my style. Shame on me, that's a loss. But portfolio managers, to your point, Guy, get fired if they're not long NVIDIA that are marked against the S&P 500 that will massively underperform. So to your point, that is a technical basis. You can justify it all you want. 20 times revenue, 25 times revenue, look where it's growing, until they're proven wrong, it's not. So again, a lot of companies, but however, it's so funny, I'm thinking about it, like, why isn't Toll saying, we're using AI mechanisms in our homes now when we build, we're making the homes more efficient. Would that make the stock go up in some ridiculous manner? Maybe. Do they care? No, because they know in the long run what they really are. A name like Tesla, Guy, and it only took me, how long were we in? We're in 10 minutes. The Tesla here that is trying to shift people, the narrative over, and by the way, failing at it, by the way, Guy, from an automotive company, which is cyclical, to something else, which it really is not going to be, and living off this kind of futuristic thing that they might be. And by the way, you had NVIDIA mention, on all their calls, Tesla's going to be such an important part of our chip ordering, the auto manufacturing, and so forth in the future. Anyway, my point is that companies are trying all they can, some trying harder than others, but a lot of these companies are what we think they are in terms of
just to button up the Tesla. I mean, again, we sort of really hone in on this for whatever reason. But again, this was a stock in Tesla that made its all-time high in the fall of 2021. I believe the stock was north of $400 a share. It's had some significant declines along the way. It obviously had a historic move in basically early 2023 when it went, I believe, from 108 to 300 over the course of 7 months or so. And we sort of got berated for missing a large part, if not the entirety of that move. But what I've tried to point out a number of different ways and a number of different times, this is still a stock that's made a series of lower highs and lower lows. And even recently, when you saw the bounce from that 142 level that we recently got down to, I want to say, Danny, at the end of April, to the almost $200 a share at the end of April, that's given back half of that move as well. So there's a lot to be concerned about, I think, when it comes to Tesla. And it's not to, listen, I don't have a problem with Elon. I don't really give a shit one way or another about Elon Musk. I really don't. I know Dan has some issues. That's fine. He's entitled to it. All I'm trying to do is point out what's been going on with the stock and the fact that a lot of people felt that we saw trough margins in the name 2.5, 3 quarters or so ago, and that didn't prove to be the case. And now he's seemingly Elon Musk going hat in hand to China. I think he made a recent trip to India, if I'm not mistaken. And then over the weekend during the Berkshire Hathaway meeting, he basically put an outcry to Berkshire Hathaway to buy his stock. So it reeks of desperation to me.
Yeah, I mean, forget all that. It's an auto company. He's doing all he can to turn into something else or make people believe it's going to be something else. But at the end of the day, he needs the auto side to work to justify valuation here. I don't think this company will get the benefit of the doubt going forward. I'm going to stay short the thing. I don't care if it run 185, 190. No. So it doesn't matter to me.
You've been right to do it.
No, because it doesn't matter to me. He has an alternate personality right now on Twitter. He's been doing these calls at night. His name's Adrian something, masking his voice. I don't know if you know about this guy.
Adrian Barbeau.
Adrian, something. I don't know what it is, but having conversations in third person about himself, referring to him, and then he messes up me versus Elon. It's nuts. I mean, so they're doing everything they can, the semi-truck and all this stuff. It is what it is. Move on from that. But my point is that is a cyclical company until you proven otherwise.
I like when I throw you off.
Yeah,
so
go ahead.
I know once I throw, because it rattles you, which I should play golf with you.
Nope.
I've said this a number of times, because you wouldn't make it past the seventh hole. It'd be so in your freaking head. You would drop your bag and walk away.
Yep.
Adrian Barbeau was the daughter in the sitcom Maude.
Yeah, her I know.
Maude was a spinoff of All in the Family, if you recall.
Yep.
I believe, if I'm correct. That was B. Arthur. Adrian Barbeau was also the love interest or quasi-love interest in incorrect. If you remember Escape from New York.
Oh, but also the Hulk. She was in that too. I think she was incredible. Anyway, please.
So Amanda's like, God, guys, please stop. I'm going to stop, and I'm going to go to the next topic because this is near and dear to my heart as well. I think I've said it countless times. I am not a fan of the Federal Reserve. I think they will go down, central bankers collectively, as some of the greatest villains of the 21st century or the 20-whatever century. I believe that to be the case. I don't think they're bad people. I think they're extraordinarily misguided. I bring that up because one of the things that sort of, I don't want to say derailed the market, but got the market a little on edge this week was some of the things we heard in terms of the Fed minutes and some of this Fed speak. So maybe you want to sort of opine there.
I mean, it's absurd that would move the markets because we already had the press conference following the meeting where the Fed minutes were taken. And as you know, they can go back and alter Fed minutes. It's meaningless to me. What's meaningful is the real-time data, which is showing that inflation is just not abating at the speed that they want, and the economy is not breaking down at the speed what they want, which investors should cheer. That is what a soft landing description is that companies are holding up and making money and earnings are decent and things are still, quote, fine, right? But we know that the backdrop behind that, and let's talk about credit spreads within that guide.
I was gonna walk you right down that
because
path,
the
baby.
Fed is looking.
Please continue.
No, since the last Fed meeting, we have another one coming up here in a few weeks. But since the last Fed meeting, credit spreads have tightened even farther. But here's what's interesting about it, Guy. There are a lot of bankruptcies going on in private company land, and I say that because they're not getting the capital. So the companies that are going to exist, the companies that are moving to investment grade, it's almost self-fulfilling that they're going to be able to get this pool of money that's kind of out there. So I think, again, secular versus cyclical, one of the things that has been occurring, obviously the secular trade within the private credit market, the secular trade within companies that are zombie companies that should have gone out of business 3-4 years ago before all the stimulus came in that are now you're not hearing about those. Where are they showing up? It's showing up in some of the employment data. It's showing up. You hear stories here and there, what's going on. But there are bankruptcies occurring. So my point is that credit spreads are tightening with the companies that have the ability to get that capital, if that makes sense. And that's great and that's healthy. And I would also argue, Guy, that I think there's a lot of people out there that would rather buy debt in a company that's trading 100 basis points over treasuries than own treasuries right here. So I think we always measure credit spreads based upon the risk-free rate, treasuries. Yeah. But I think what we're missing here is maybe the treasuries not being deemed as risk-free as we appear, whether it's 50 basis points, 1%, whatever it might be. I think that's kind of the problem with looking at it that way, if that makes sense. And again, that's a secular move here. So this, we go back to the pandemic and go back to everything. It's kind of changed the landscape for a period of time. We keep wanting it to basically rectify itself in a, quote, normal manner. The normalization is going to take several years. The Fed intervening in 2008 with all these programs and the QEs and all, this has muddied the waters, so to speak, right, in terms of how we look at these markets historically. And I'll say this again, and I've talked about this on the show, you have a generation of traders that never traded before 2008. They don't understand anything else. It's not their fault. They just don't get what normal looks like, a normal cycle without government intervention. So there, I went off on a tangent there. But point about the Fed, Guy, is that people believe that they're going to be there, and they probably will. And I want to say one other thing that's come out, obviously, in the last couple of days. We talked about last year, that the Basel III implementation on the large cap banks, it's actually Meredith Whitney had this story over a year ago. Again, to her credit, people should be paying attention to her more than they are. Was talking about down in D.C., the talk was that, you know what, during the CRE, it was because all the commercial real estate stuff was happening. The Fed, think about it. common sense tells you that after all these years of doing things, what are they going to all of a sudden implement these stringent standards into these banks at a time maybe when we actually do go into a cycle or recession? So that's been the other reason, kind of guy behind the scenes, that banks have been trading, I think, a little bit of premium to where people think that they should be. The large cap banks, which have been the rescuers of potentially small and mid cap banks that have problems, right, that we've seen. And just the banks are fine. Those are utility stocks, in my opinion. So the utilities are now AI stocks, and the banks are now the utility stocks to a degree. So a lot of stuff's happening, down in Washington, the Fed and the FDIC, obviously scandal there and so forth. But at the end of the day, the banking system is fine. This trading off what the Fed is saying or not saying in Fed minutes that are a month old is absurd, in my opinion. The real-time data is telling us all we need to know. So,
all right. So bookmark the banks for a second, okay? So I'm going to come back to the banks personally because I have a couple comments and I have a question for Danny. In terms of what's going on with the bond market, and we are now approaching June of 2024. As we entered March of this year, I believe this to be true, we basically then put in the longest, in terms of duration, the longest inverted yield curve. And I think that broke the record set, I want to say from 78 until 80-ish, 1978 until 1980-ish. For whatever reason, Danny, the market has seemingly forgotten about that. I think that's problematic, and I think they're going to rue the day that they did that. I'll say this, and I'm starting to really start to believe this. I think the opportunity in the yield curve, and Elizabeth Young and I had this discussion the other day, is going to come in the form of short-term, like 2-year yields. I do think there's a chance, if things start to slow down, you're going to see a significant move lower in the 2-year. And I think what's going to wind up happening is that inversion is going to steepen in the form of the 10-year yield trading back up towards 5%. We'll see if that plays out. Again, I think I know what it means, but we'll see. But be aware something's going on. In terms of the banks, and I'm glad you brought that up, certainly banks in this environment should be trading like utilities, but they're trading anything but. I mean, JP Morgan, for example, has been sort of lower left, upper right now for quite a long period of time. What I found fascinating this week, Danny, I'm curious to your thoughts, Jamie Dimon, and again, I don't know the context of this, if he was prompted or if he said it on his own, but he basically said that JP Morgan, the stock, was expensive and they would not be buying back stock at these levels. Now, what does expensive mean? I have brought this up a number of times. It's not a price to earnings thing for me. To me, it always comes down to price to book and price to tangible book. At its recent zenith, an all-time high in JP Morgan, north of $200 a share, the stock was trading almost 2.35 times tangible book and approximately 1.9 times book value, which are both levels we effectively saw pre-financial crisis. It's not an indictment of the company. It's just the valuations got stretched. And at least he acknowledged that. So again, my question to you is, when you hear the most important banker since JP Morgan himself say something like that, and I said it on Fast Money, I mean, if Jamie's not buying it, you shouldn't be. Thoughts?
Well, I mean, he's honest, and I think he's always been transparent. He always speaks his mind, and that's always rewarded him. And I think investors like that. So let's separate his comments right now from these banks and where they are. So you've had a pickup in M&A, a pickup in IPOs. Basel III, I told you, is going to be relaxed to a degree, right? You've got potential capital restraints being lifted a little bit, and things are, quote, calm in that land. And let's not forget, again, they're going to be needed potentially to bail out other banks. And they're still integrating some of the acquisitions that these large banks have made, and that's very accretive. So let's put that to the side. So what he's saying is he has other use for his capital. He doesn't need to buy back stock, right? Whether he wants to go hire a new unit, whether he wants to pay a larger dividend, maybe it's a special out to the shareholders. That's not a good move with your bank. So banks traditionally trade on return on equity, right? So the ROE number, to your point, that's how kind of the valuation is really determined. So X amount of equity, what is your return? Now, pre-financial crisis, the ROEs were massive because these banks were using their balance sheets, taking massive risks, producing massive returns, and really it was abnormal. We then reverted back, obviously, post where they were completely handcuffed, and you saw what a normal. So anyway, trades off of that kind of. But I think, again, Guy, it goes to, again, passive flows, large cap managers based on the S&P 500. What banks can I feel, quote, safe owning? And the premium, they're getting a premium, these large banks, because it's safety in numbers and size. And that's really why. it could easily trade down from $200 to $150. You have the same exact company, same complexion, same argument, same everything. It wouldn't matter. But the other thing, Guy, is that credit still seems to be okay for most of the consumers that are out there. Not on the lower end. JP Morgan will always have every type. They touch every type of consumer, but things are still fine. So you have a lot of reserves built up. You could release those reserves potentially if we don't go into recession. So, Guy, make no mistake about it. If we do start to enter a recession or things start to look like these stocks will come down dramatically, especially the ones that are exposed to the U.S. consumer. And he knows he's just being cautious. And so I have no problem with anything that he said. And I guess shame on him for being honest, right? What is he supposed to say? I'm going to go back and buy back stock here. He waits for a rainy day. He's a smart guy. So.
And the counter to that, by the way, before we move on, if I recall, it was a Friday in February of 2016. I don't have the exact day in front of me, although I guess there are only 3 that month, so I could take a shot and guess. But the market was getting schmeizled. And I recall on that day, Jamie Dimon himself announced that he was personally buying JP Morgan stock, and the stock was trading approximately $54 that day. That coincided with a bond offering that Deutsche Bank did, which sort of stemmed the tide there, because that was basically upper left, lower right, if you go back and look. And there was news out of OPEC. So those 3 things came out, and that basically put a bottom in for the stock market and the JP Morgan stock itself. And the only point bringing that up is, when he announced he was buying the stock, everybody took that ball and ran with it, as they should have, quite frankly. And I understand people's want is to be bullish and to find bullish things, but the same should be true when he's effectively saying, you know what, this is not a level to be buying the stock.
Well,
and I understand that maybe that's not fitting the narrative, but I think it's important to make that point.
Well, there's personally buying, and there's companies' balance sheet buying.
But you understand.
No, I understand what I'm saying. Hold on.
Right.
And he sold stock this year for the first time in a long time. So, listen, I'm not going to try to time JP Morgan, but again, would I own it here? No. I wouldn't own the stock. I think there's other things that you can.
But I think I'm just JP Morgan to me is a microcosm of a lot of different things.
I agree.
Anyway, okay, so play this game with me, if you will, for a second.
Here we go.
Okay, things that suck for 500. Will you do this?
I can do that.
Can you do that?
I can do that, Alex.
Nick injuries in the playoffs really sucked. I mean, that was a good Nick team. I love Jalen.
What
Brunson.
is not a deep bench? Okay, keep going.
That is not a deep bench, but they really were decimated by injuries, so that sucked. Okay. The New York Mets suck.
Right.
I mean, I'm just telling you flat out.
What is a below 500 team, Alex, for
what
1,000?
Is a below 500 team with a ridiculous payroll?
All right.
And you know what else sucks?
Yeah.
Soccer players that go down like they were shot by a rifle when they're not touched by anybody. I mean, the feigning of injury in soccer sucks.
Okay.
You know what else sucks?
Yeah.
The Bank of Japan. They really suck.
You know what?
How
did you get
there? I'm sorry. Listen, if I'm offending any central bankers in Japan, too bad. Because
they definitely listen. We're very popular in Japan. Yeah.
No. Well, listen, maybe we should be.
Yeah.
Because we've been pointing this out. You have, I know, and I have. They've screwed the pooch. And okay, guy, what does screw the pooch mean? I'll tell you what it means. It means now, since yield curve controls, and you did a whole thing. What's that person's name?
Janet Jackson. Control. Yeah.
You did a whole podcast on it months ago, right?
Yep.
I mean, that genie's out of the bottle. 10-year yields now are either side of 1% for the first time, I think, in 14 years. You can correct me if I'm off, but I think I'm right. And it's coinciding, by the way. One would think with yields going higher, the currency would strengthen. No. Dollar yen is back above 157, having traded down to 152 and change after the Bank of Japan intervened twice. They're screwed, whether they should know it. If they don't, that's even more problematic. Thoughts on the implications of that? Because again, I think it's somewhat far.
Let me give you the 97% of people that'll say versus the 3% of people. 97% of people will say, who gives a shit about the BOJ?
Okay.
Hold on.
Okay.
Just so you know,
fine.
you and I are in the 3. 97% of people gives a shit about the BOJ. Look at Nvidia's earnings. Screw yourself. Okay, that's fine. I get it. But let's talk about what it really means. Again, it's the beginning of the central bank experiment. It is Beaker in the Muppets with that Swedish professor running around making stuff up in the lab and all that stuff, right? Professor Cantaloupe or Melon something, whatever he was. Anyway, so what are they doing? Now the 10-year in Japan is at 1%. You say 1%, that's really nothing, except it literally was 30 basis points last year. That's the first thing. The problem is the amount of debt in Japan. Again, over 250% debt to GDP. Great. Good luck with that. We're gaining on them quickly by the day. And the last thing, Guy, is that they have to pick their poison. What is their poison? Do they support their currency, the yen, or do they come in and buy bonds, right? What they're going to do. So they have a BOJ meeting here coming up in a few weeks. I think it's the week after the Fed. I think it's June 18th or something is when they have their meeting. People are looking for something. We know they've been intervening, potentially in both, but certainly in the currency. And that's the currency is traded from as weak as 160 down to as strong as 152. We sit here, it's 156, 157. The bottom line, guy, with this is that they have so much debt that they can't afford to mess around over there. And it matters because it can roil kind of the global markets. But more importantly
100%.
to me, it's symbolic of this experiments which have gone on now for decades in terms of so to me, that's why it means something. Does it mean anything right now? Absolutely not. If you're using that to trade these markets right now, it's a fool's game. But I think we point out just to pay attention, and when the time comes and you look up on Investopedia and you start trying to figure out what the hell is going on, let us provide some information for you. That's all we're saying. That's it. So,
I believe his name was, and if I pronounce it incorrectly, I apologize, but Chris Ray. I think it's spelled REA, and Danny's like, okay, Danny's got a small can of Coca-Cola in his hand.
I do,
and he's saying, okay, guy, I have no. Because what I like to do with Danny is I just like to do this.
You really
just
send me,
throw you off.
Okay.
But he's saying his one and only hit, I believe, was "Fool If You Think It's Over." Do you remember that song? It's a great song. I encourage you to go to my Spotify playlist and find it because it's a very well done song. I'll say this: you're foolish if you think it's over in Japan, because I'm not saying you, Danny. I happen to think it's just getting started. And you're right to say you can't trade the markets on the back of that. But I still think Japan, unless I missed something, is the third largest economy on the planet.
And the largest foreign owner over U.S. Treasuries. So,
thank you. And if things start to go pear-shaped there, it has ramifications.
For sure.
So you see the way I tied that?
I did.
You didn't know where I was going.
I knew where you were going.
You had no idea.
Keep going.
That's why you just got to trust me.
That's right. You've now passed. You've passed 5 songs, and you haven't gotten to concert promoters yet, because I want to get to this.
Okay. Bear with me. I mean,
we're running out of time. You got the back end. These ladies.
It's our podcast.
Right.
By the way, if you want to hear more about that whole Bank of Japan stuff, I think it was 6 podcasts ago. Amanda can put it in the notes. You and I sat down with Mike Cow, the urban cowboy, and we discussed this as well. Okay. Dan Nathan, you're saying, where's Dan Nathan? Go ahead, say it.
Where's Dan Nathan?
Good question, Danny. Dan Nathan is once again doing his pilgrimage to see the band Pearl Jam. I think he saw them in like Seattle and California.
Portland, California.
He sees Pearl Jam more than the spouses of Pearl Jam, which is somewhat problematic. But hey, everybody's got their thing. Yep. Why do I mention that? Because Live Nation is back in the news, Danny Moses.
They are. And the DOJ, I think something that everybody can kind of agree upon is that Live Nation has too much power. They own Ticketmaster, which basically own the concert venues. They own the way you distribute tickets. 70% of tickets are basically handled by Ticketmaster. You got obviously the StubHubs of the world, making up the balance here. But, it turns out, which I actually was unaware of, that the former chairman of Live Nation runs a company called Oakview, which oversees, I guess, dozens of arenas around the world. So they manage those. So it really is a monopoly. So I think, obviously, Merrick Garland's leading this. I think at least 30 states have signed up for it. I think everybody kind of wants to see that. And now Dan, instead of spending $500 a ticket, maybe can spend $400 a ticket if they get this right. So again, this is where every consumer should care that sometimes this antitrust stuff and government intervention can kind of help people. So people should read it just to know what's going on with it, obviously. So,
well, the stock saw a pretty precipitous decline. I think it was down about 8% or so today being Thursday. So that's one to watch as well, because once you get a microscope from those folks, it typically lasts a lot longer. It's like a proctology exam. You don't want to go, and it lasts longer than you want. Now, people will also say, you know what, guy, you're a jackass. Okay, you bring Mike Wilson on when he fits your narrative, but when he basically acquiesces, you don't talk about it. Okay, let's talk about it, because earlier this week, Mike Wilson effectively pulled a Roberto Duran and said, no mas. I have the utmost respect for him. I think you do as well. We're going to have Mike Wilson on, I think, over the next few weeks, so stay tuned for that. But now Mike Wilson has abandoned ship, effectively. There are a couple people left. Actually, he left the ship, and Jeff Gunlock has jumped on it.
And Marco
Kolanovic from JP Morgan remains on it. I think Marco's got a $4,200 price target on the S&P. So thoughts on that?
Listen, I think Mike sees and senses what we are, what we're seeing, right? In terms of, we talked about the credit spreads, even if it's symbolic in nature. We talked about the people's belief in this forward earnings curve. And again, it's going to take a lot to kind of prove the negative, or the burden of proof, I think, is on the bears, not the bulls at this point. And instead of fighting, he's just saying, and listen, let's be clear, he's not going bullish. He just went less bearish. I think his S&P upside target is 2% from here or something like that. And again, meaningless S&P targets. And just for the record, he's gotten a lot of his industry stuff right. So he can
100%.
he can make an S&P call and it'd be one thing, but you still make money with Mike Wilson, just so everybody's clear. Don't just label him as a bear and just the guy is thoughtful and really goes into it. So, he says, screw it. I'm not going to fight this anymore. And you know what? In a month or 2 months, if he senses something different, he'll come right back. But I got to tell the bulls out there, when people like Mike stop being bearish, when you have, it's like a stock, when it has 50 ratings and all are buys, you want people on the other side to point out the stuff that you should be looking at. And Guy, he's still pointing out all of those things. This is a question of, symbolically has changed course. So
nothing's going away, and we will have Mike on. So stay tuned for that. But I wanted to address that. Now, something happened the last couple weeks that I didn't see coming
in here.
Yeah. Look at you.
Yeah.
What it is ain't exactly
it's pretty,
clear. And it wasn't clear to me because some dipshit Twitter account waxing kitty or something came out with some cryptic thing. Now, for just so we're, sort of some context, GameStop, the stock, GME, has effectively done nothing. Well, I mean, it's gone basically lower. It's like lower left, upper left, lower right for quite some time. But something magically happened, I don't know, a couple weeks or so ago, when the stock basically went from 18, Danny, all the way to 50, if I'm not, maybe even north of 50. I mean, might have gotten north of 60, and we've round-tripped the entire thing. AMC has done similar because, again, the meme shit is back in vogue. Everybody's in. And, oh, by the way, a gentleman with a very famous last name, I think you might be familiar with him, sort of the royalty of the United States, the Kennedy family.
Yeah.
He announced that, you know what, I'm with you, and we're going to take on the man and blah, blah, blah. And he bought $24,000 worth of GameStop because it's a rigged system and all those different things.
Yeah.
As it turns out, fundamentals do matter, and both AMC and GameStop, despite what people think, are still flawed companies.
All right, Guy, let's take these one at a time. I didn't get to talk about these last week when we had Steve Eisman on because it was more important what he was saying than talking about these companies at all. I just think it's important to note. GameStop and AMC, both these started moving on whatever tweets that were out there, leaning forward, a kitty leaning forward, looking into the screen, and maybe that he's back involved again, whatever it might be. Both companies took advantage of the moves. What do I mean? AMC ended up issuing stock at $3.45. Okay, granted, stock went to 10. It's going back to that $3.45 number. So good for them, smart. They did a debt for equity conversion. That's the stuff you should do to take advantage of nonsense that occurs like that. Granted, they're still screwed, AMC. Balance sheet is still shit. It won't matter in the long run, but they get to live to fight another day. GameStop, on the other hand, right? You still have a chairman and now acting CEO who's still under investigation for his trading in Bed Bath & Beyond, which has changed this company's profile to become an investor of other things other than GameStop. They're shrinking the core business. They have $950 million in cash. They just announced when the stock went up, they're doing an equity offering of 45 million shares. Jefferies is leading it. So they're going to try to take advantage of this, right? So I think there's nothing to really do on the short side here necessarily in either name, but the people that buy into this stuff, you want Ryan Cohen, and I was saying this all along, they had a buyback in place of over $100 million when the stock was sitting at 10. Actually talked about it on this podcast. What better use of of that money than buying their own stock back if they really believed it? So anyway, I feel bad for the people that chased the stock up to $60 in the pre-market GameStop. It's lost more market cap already in the last week than it was totally before this whole thing started, and people get burnt on it. So we want to protect people. You're not missing anything. Go buy something else. Go buy some quality stuff and just ignore these names. So I don't want to spend any more time on it. Just know that these things upset me, not because I'm short them or anything like that, because I see people losing money coming, I'm out of GameStop. I'm back in. There was probably people that had finally sold GameStop at $12 or $13 and said, I learned my lesson. I'm done. And they're like, I can't miss it. I got FOMO. I bought it at 30, 35, 40, 45. It's going back to $10, Guy. So if they raise the $900 million, does it live to fight another day? Yes. But again, by the way, in all of this, when they announced this offering, guess what they also did? They puked the quarter. They pre-announced the quarter, how bad they're losing money. They're not going to make money again. So anyway, that's all I got, Guy.
Well, look, I mean, it's also indicative of some sort of animal spirits coming back in the market, maybe at the precisely wrong time. So just sort of bookmark, that series of moves in those two stocks, along with what we're seeing, obviously, in the S&P over the last couple days and what we're seeing with interest rates, we will come back to this one way, shape, or form or another over the next few weeks. But this is, to me, all signifies and signs of, a potential sort of blow off top. We'll see. By the way, as we're sitting here, it's now Thursday afternoon, and this just in, that 8-9 horse combo parlay, they just finished in the Preakness. Just crossed.
Oh, I was supposed to know that it was going to rain a foot. In the mud was going to literally take us over. But that's fine. You can't predict everything. It's a horse race, guy. Good luck.
I'm playing. You do know that I'm playing.
Well, it hurt me. It hurt me financially. So I put my money where my mouth is. Yeah.
Well, that's why you have to wait till post. You don't know.
All right. So
you have to wait and see.
So I lost the Derby. I lost the Preakness. I guarantee I hit the Belmont, which is in Saratoga. Okay. And I will be there for that.
No. That's fine. So
I'm going to call in from there.
So that's not this Saturday. That's not next Saturday. It's the following Saturday. Right. So there's 3 weeks in between.
Yes. It's
because the Belmont, which is run at Saratoga this year, because they're pouring a shitload of money into Belmont Park.
Next 2 years it's running there. Correct.
Next 2 years.
So June 8th.
Wow.
Correct. June 8th, I'll be up there. So yes, I will have
Will you be at the spa?
I will be at the spa. I will spend some time in the stables I will look the horses in the eye like Richard Dreyfuss and Let It Ride. And maybe I get that wink. By the way, one of the great sports betting movies of all time, Let It Ride, Richard Dreyfuss. You definitely haven't seen it, guy. Amazing stuff. Trotta.
I have not seen it.
Watch it.
How many horses will make it to the?
Don't know
I
yet.
had to guess, it'll be 6 horses.
No,
maybe.
more, because it's 1 1/4.
Okay,
they're running a 1 1/4, so it doesn't.
They're not running 1.5 miles.
See, guy, this is what I'm here for. Jay Sloan should block you right now on Twitter forever.
I didn't know that.
It's 1 1/4.
Sorry, I thought they were going to keep the same distances.
No,
but
see,
running at a different
that's why
track.
people come to the podcast to learn that. Yeah, 1 1/4.
That's news to me.
Yeah.
I mean, why wouldn't before we get out of here, and we are going to get out of here, why wouldn't they leave it at 1.5 miles?
The track is not suited that way.
Conducive to that.
It's not. You have too many turns.
They could. I mean, you could do it.
You don't want to do 3 turns. I think you don't. Horse people know that. No, you won't get any horse in it. If you did 1.5 miles at Saratoga, you wouldn't have anybody. It's too much.
Because you'd have to do Basically, you'd have to do
3 turns,
2, 3, and 3 turns.
3 turns basically. So no one wants to do that. So that I get into the horse thing a little bit too much there.
Man, that's deep. That's inside baseball shit right there.
Let me tell you, it really helps me make money. Anyway, please get us out of here, guy.
Well, I've enjoyed this.
Me too.
See, I'd lead you, when you trust me, I'd lead you down the road. Sometimes I go in circuitous routes, but I always come back to basically the North Star. The North Star, just trying to help people out. And I thank you for sort of indulging me, Danny Moses. I thank the audience as well. But don't leave, because after the break, Dan Nathan and I sat down with Kristen Kelly and Jennifer Sarbach. You might know them better as the Wall Street Skinny. See you in a bit.